I think the equities rally, we're going to continue to see precious metals and silver. We are long SLV with our last trigger here. We hit a 15% target. We are only in this very short period of time. We hit a 15% target on that. Letting that continue to mature, I think we're going to see the metals have that final blow off top, a big surge higher that I've been talking about for a couple of years that we've been waiting to start to see signs of, and we see all those signs now that everyone is now attuned to the precious metals space. Any type of metal, anything with mining related, money is flowing into it, big volume, and that's telling us we're in that. Let's dive into the charts. Equities are moving higher again today. We got the NASDAQ up 0.7%, the S&P 500 up about almost 0.5%, the Russell up 0.6. So we're seeing large caps and small caps move up, which is a little bit of a kind of a broad base move. If we take a look at last week's price action, we saw the market on the 30-minute chart keep dipping and pushing deep into oversold territory, meaning price-wise, it moved down too quickly in too short period of a time, and that puts us into an oversold conditions where the market tends to get bought back up. Now, we also saw some panic selling, very little, but we did see some panic selling. And while we didn't see some huge outflows over the general stock market, we definitely saw the general market participants starting to get scared and to give up on the holiday, the Santa Claus rally here. And we'll see how that unfolds. It looks like the market's carving out a bottom, maybe an inverse head and shoulders. Either way, it's a rounding formation. This week, I think, is kind of do or die. Either we're going to see the market pop and really start to extend, or it is going to struggle kind of like what it did last year and kind of chop sideways and potentially not really go anywhere. So that's kind of where we're at in terms of the price action. The daily chart shows we've come down to the 50-day. We've got some volatility. We've had a batch of selling days. So we've got like 5 down days in a row. Typically, when we have a bout of multiple 5 days or so of selling, we tend to see a little bit of a relief bounce. And that's kind of what I think we're going to walk into this week.
From a technical perspective, recent selling has been intense but orderly. Multiple consecutive down days often exhaust sellers, setting the stage for a relief rally. Key moving averages have been tested, volatility has expanded, and short-term indicators suggest price moved too far, too fast. These conditions rarely persist without some form of rebound. Short-term charts also hint at early morning price spikes that often guide intraday direction. Gaps higher at the open are common under these conditions, though history suggests they are frequently faded before the market chooses its next direction. In other words, volatility remains elevated, and timing still matters.
Now, if we take a look at the 10-minute chart and the price spike chart here, let's just move over here. We do have a price spike to the downside, bringing us back to pretty much Friday's close. That means the market, I would not be surprised if the market gaps higher by 9:30, and then we potentially see it sell off and move down. Now, these price spikes, we went over these in pretty good detail in our mentoring session on Friday. We also talked about how to trade the volume by price, how to know where all of these levels are. And of course, we went over a whole bunch of these price spikes. When we go back here, you can see when we have these price spikes and these third, half, and 100% targets, how usually we get these spikes at about 8 o'clock in the morning. It tells us where the early morning move should be. We had a spike here telling us the market should sell off at the open, another spike here saying it should sell off for the day. We had another spike over here for a sell-off. Today, we are going to see the market gap higher, which we know gaps for the stock indices typically get sold into, or they get filled. If it's a gap up, they usually fade back down after the open. If it is a gap down, they usually fade back up to fill those gaps before going further. Now, we have some pretty good momentum potentially kicking over, so I wouldn't be surprised if we actually see it gap higher, maybe fill a third, maybe hit the first third or half of the spike. Doesn't always have to go the full spike distance, but usually the first or second little target we have on there, and then the market can turn around and go higher. There are some huge gaps lower on the charts from a long time ago that still need to get filled. And so I do believe we'll eventually have a big market reset, and all those gaps that we've got over the past year and change will end up getting filled at a later date.
Markets no longer operate in a purely organic environment. Central bank liquidity continues to distort natural cycles, suppressing deeper corrections and prolonging rallies. While this support can sustain prices longer than fundamentals alone would justify, it also builds structural risk beneath the surface. Long-standing gaps lower in equity charts remain unresolved, suggesting unfinished business. These gaps tend to close eventually, often during sharp market resets. For now, money continues to flow into equities, but the foundation feels increasingly artificial. Stability driven by liquidity injections can persist, but it rarely resolves risk. It simply postpones it.
Now, money is flowing into stocks. It is also flowing into precious metals. We have gold breaking out to new all-time highs today. We have silver most likely hitting all-time highs, pushing up again, up another 2.3%. So we're seeing money move into gold. This is all one of those big warning signs saying we are getting closer and closer to, I think, the music coming to an end for the equities market and for the economy. But we do have that wild card of the government, the Fed, building their balance sheet, doing quantitative easing, and that might support the markets. It's really tough when the game is rigged and they just don't let the market have its normal ebbs and flows. They just continue to juice things. So we'll see how that unfolds. But overall, equities are wanting to move higher. Precious metals are continuing to lead the way, telling us and warning us that something bad is coming eventually in this market. Now we have platinum and palladium both up almost 5% for platinum. Big pop and run. We got palladium up 3.75%. Let's take a look at palladium. Again, the whole precious metal complex is on fire. Anything that is a metal of any sort or has a word that says mining in it has been moving up. Today we are seeing probably the gold miners move up as well. And we've got, so the stock market is up today plus precious metals. So that means we should see the gold miners, silver miners do very well.
While stocks grind higher, precious metals are sending a very different message. Gold is pressing into record territory, silver continues to surge, and platinum and palladium are delivering outsized gains. When capital flows aggressively into both equities and hard assets simultaneously, it often reflects underlying uncertainty. Investors appear to be chasing returns while quietly hedging risk. Historically, sustained strength across the entire metals complex has preceded economic stress rather than economic expansion. Mining equities tend to amplify these moves, attracting speculative capital. The message is subtle but clear. Protection is being accumulated alongside risk, not after it.
If we take a look at crude oil, we've had the charts down at support for a while. We talked about how usually when you come down to a very critical support zone, we should see some type of bounce, it's going to try to recover. And that's what it's doing. It came down, it really tested that level, pierced it by a little bit. Now it's having a bit of a bounce. The overall trend for oil continues to be down. And I feel like it's just a matter of time before the $55 per barrel level is breached and closed below and we see a big breakdown. But at this point, it is still clinging on, trying to hold support, even though it did pierce it and trade a little bit lower already last week. Taking a look at Bitcoin, having a little bit of a 2-day bounce. Again, stocks bouncing, stocks want to bounce as well. Bitcoin will want to bounce with it. They're kind of a risk on, risk off trade. When stocks go up or the NASDAQ, we tend to see Bitcoin move. Not perfectly, but that is the general bias. As soon as Bitcoin got sucked into the futures market, it now has the ebbs and flows of people naturally buying or selling, just like in the stock market. They're all the same, more or less, group of people. Same hive mentality. When people are nervous, they sell things. When they're bullish, they buy things. And so that's the problem with Bitcoin getting sucked into the financial system and being somewhat regulated now. It's going to start to move more and more like the stock market. It becomes a similar trade.
Energy markets offer another clue. Crude oil has staged a modest bounce after testing critical support, yet the broader trend remains fragile. Weak energy prices often reflect slowing global demand rather than strength. Bitcoin, meanwhile, is rebounding in tandem with equities, reinforcing its evolution into a risk-on asset. As digital assets integrate deeper into traditional financial markets, their behavior increasingly mirrors investor sentiment rather than standing apart from it. This correlation suggests that when risk appetite fades, crypto may no longer offer insulation. Across asset classes, optimism is returning, but it feels tactical, not structural.
Anyways, this week will be pretty exciting. I think we're going to see, the equities rally. We're going to continue to see precious metals and silver. We are long SLV with our last trigger here. We hit a 15% target. We are only in this very short period of time. We hit a 15% target on that. Letting that continue to mature, I think we're going to see the metals have that final blow off top. A big surge higher that I've been talking about for a couple of years that we've been waiting to start to see signs of, and we see all those signs now that everyone is now attuned to the precious metals space. Any type of metal, anything with mining related, money is flowing into it, big volume, and that's telling us we're in that feeding frenzy phase, which means there's probably quite a bit more upside, but it also means we're in the second half, the back nine, the last big push, I think, for the precious metal space to have this run. And then after that, everyone who's open to buying precious metals will be in the metal space, and then it's going to deflate and pull back, and we'll see a wave of fear and selling, and we'll see a big correction. But again, I still think we've got lots of upside here over the next 1 to 2 months. Silver may top out before gold. We talked about this in our mentoring session. Silver in 2011 topped out 6 months before gold did. So this is what we talked about last week as well, is about how silver is a trade. And I think gold will eventually take the lead here once silver loses its momentum, and gold will keep going up as the defensive play, and silver will actually start to struggle for a while. So silver is a quick trade. You play it, be ready to move aside to lock in gains if you're trading ETFs and just going using it as a trading instrument versus a long-term investment.
The surge in precious metals may represent a powerful final phase rather than a new beginning. Historically, silver often peaks before gold, acting as an early warning for traders. As speculative enthusiasm intensifies, upside potential remains, but so does downside risk. This phase rewards agility, not complacency. Once participation becomes universal, markets tend to correct sharply. Over the next 1 to 2 months, metals may extend higher, but longer-term investors should prepare for volatility and eventual pullbacks. Gold may ultimately resume leadership as a defensive anchor, while silver transitions back into a tactical short-term trade.